So on the fixed strike vol side, we saw S&P down 3%. So a reasonable move here, 1.5 sigma on the week. What did vols do? You can see pretty much green across the board. Obviously, these upside calls in the front end really catching the biggest bid because they were the ones on the 9 vol. And as you move away from them, they're very low premium options and they're also very decent gamma, right? They're very good value gamma. The best value gamma is that stuff on a 9 handle that you're moving away from. And this is actually a point. This is something that most people don't realize, right? When you're long gamma, you actually want to move away from your strikes, right? So as a dealer who's running a book full of options, you want to own strikes that you move away from, and you want to be short strikes that you move to. Provided you don't go blasting through the strikes that you're short, you actually want to go towards short strikes, and you want to own strikes that you're getting away from, because then the Greeks evaporate, you benefit from the gamma positioning, but then you don't have a load of theta to worry about, you don't have a load of vega risk to worry about, you just get to monetize the gamma because you've moved so far away from the strike. So that's why these things go quite well bid when the market sells off, because you're getting away from them and they're on a super cheap vol. So they're actually really working quite nicely. Okay. But in general, you are seeing, an uplift in vol, fixed strike vol up, anywhere between half a vol and a vol for the at the monies to the downside strikes. Suggesting that dealers, are losing a little bit of vol inventory as we sell off, which is typical. So, that big JP Morgan call strike at 46.60 didn't come into play. But actually, the short strike, the put strike that they bought is on a 42 handle, I believe. I can't remember exactly where it is, but it's basically in this area around 4,200. So if we continue to drop next week in the order of magnitude 3-4%, then that gamma position of that JP Morgan short strike actually comes into play. And dealers aren't long gamma, they're very short gamma down there. So that does explain why this uptick we are seeing in vol. It's not too violent right now. And the flip side of that is, if we know dealers are all short that put down there that's got a bit of juice on it now, they're all short futures against that as well. And what do we know? Like we've seen in all the OPEX, all the monthly OPEX is you see when dealers are short the downside and they're short futures against it. If the market doesn't go down through those downside strikes, the charm impact is to cover delta. So it's a weird one where that in the first half of the week, it's going to be a case of there's going to be charm impact supporting the market. But if the market is in a bearish sort of mood and it manages to get through that lower strike, that could cause an acceleration. Okay. So we're in a bit of a precarious spot here. And with the CTA stuff that's being projected in terms of how much these guys need to sell, I would be careful, right? Because there could be a pocket here where the market has a bit of an air pocket lower through that JP Morgan strike. And then once that all goes away, then the market's free to rally. So that's why I'm quite happy to have a bit of long vol in the book and to lean a little bit flat to short and not be caught long the market, because I do think there's a bit of an air pocket here in the very, very near term. And we want to kind of let that expire and go away. Okay, those are my thoughts there on that side of things.